You've been thinking about real estate all wrong. It's not a passive income stock. This is your own business that you're going to be growing over time. And that should be the playbook when you're looking to buy in this market. Welcome to the Ken McElroy Show. Today we have on Dave Meyer from BiggerPockets. Welcome.
Thanks so much for having me. I'm really excited to be here.
Yeah, we're excited to have you on. You know, BiggerPockets works with a lot of small real estate investors, and that's a big portion of our audience as well. And I think you'll bring a lot of insight about the economy and what's happening in investments.
I hope so. Thank you.
So I guess the first question that is kind of on everyone's mind right now, based on everything that's happening in our economy, is everyone kind of anticipated that rates were going to go down this year. And it looks right now like they're pretty stagnant, and maybe even, the Fed funds rate might even go up.
Yes.
So how does that adjust, your thesis on buying this year?
I will tell you, we don't know each other well, but if you did, I'm wrong all the time. But this is actually something I think I've been right about, is I've not bought into the rate going down thesis a lot over the last couple of years. Not because I'm particularly great at telling the future, but we just have huge amounts of global uncertainty just all over the world. And that doesn't bode well for mortgage rates coming down. Bond investors, the people who really control mortgage rates, whether we like it or not, they don't like uncertainty. They want a clear path on inflation. They want a clear path on economic growth. And unfortunately, we just don't have that right now. And so I actually think this year is shaping up, at least in the residential market, pretty close to how I was expecting it to, because I think we're in this period called what I call like the great stall. I think rates are going to remain relatively high. I think we're going to have years of probably pretty slow appreciation across the country. It's obviously going to be pretty different, but I don't think that means you can't buy. And I know that scares a lot of people when they hear that prices are going to be flat, and I could be wrong about that, but I think it's actually a time for people to reassess, rebalance their portfolios, and start buying some of the better opportunities that are coming into the market.
Yeah, and I would just add, I think that the Fed has a few things. They have headwinds in a few things. One, the global uncertainty, certainly. But the potential for inflation, I think, is a big one. And then the bigger one, I think, that's under the radar that people aren't talking about is the potential for high unemployment.
Yeah.
I was on a phone call today with a good friend of mine that laid off 5 people and is saving $400,000 due to AI.
It's scary.
I said, wow, that's a lot. He's got maybe 30 people. I said, Michael, that's a lot. So, whoa. And I said, what positions? Marketing, customer service. He goes, we have one person that can do a lot more now because we're using AI. So, and I don't want to go down this AI hole too far, but I just believe that companies are feeling inflation, they're feeling rising costs, and they're looking at their own operating expenses and trying to figure out how to just kind of do what they did last year financially, but for less money.
A little bit less.
Yeah.
And those two things combining, or the risk of those two things at the same time, is really the challenge, right?
Correct.
Because this is what hamstrings the Fed, right? If you ask, I always ask this question, but if you ask 50 people, 100 people, who's more worried about inflation, 50 of them will raise their hand. Who's more worried about a recession, 50 of them will raise their hand. Yeah. And until you have clarity on that, mortgage rates aren't going to move that much. And it does, we can get into this, but those two things combined can happen. That's stagflation, right? That's a tricky situation to navigate out of. And hopefully we won't be in that. But I think that's why we're in this weird market that we're in. And I don't know what you two think, but I kind of think we're in it for the foreseeable future right now.
Yeah, but that 6 to 7% mortgage rate has always been pretty normal. Mm-hmm. It just hasn't been normal in the last 10 years. But prior to that, those were just average rates.
Yeah, I think long-term average of the last 30, 40 years is right around 6, I think.
Yeah.
So it's really not that unusual. I think a lot of it is psychological, actually. Mm-hmm. It's that people got anchored into these really low rates. I mean, I started in 2010 investing. I never saw a 6% mortgage until 2 or 3 years ago. And it just takes a little bit getting used to, right? But I do think people are getting used to that, and that's the good thing. And the other thing is, for the better or worse, it's going to force prices down a little bit. I am not someone who's forecasting a crash or has ever, but I do think, sellers are going to have to get realistic. There's too much unaffordability in most markets for prices to remain this high as long as rates are this high. At least that's how I see it.
I'm going to throw a curveball, though, even though I think we have to acknowledge that we have a president that has historically liked to drive down rates, right?
That's right.
He's been battling with the chair. He's out. We got a new one in, or not quite, but almost in.
Yeah.
And whether he's correct, he did the $100 billion buy down with Fannie and Freddie, and he's looking for ways with the 401ks and retirement plans and things like that where people can use their money. And he's talking about longer term mortgages and portable mortgages and all these crazy things. He's throwing everything at the wall, which is what he does.
Yeah.
But he's trying to figure out a way, to make these rates go down. Obviously he can't do that by himself, but I don't think he's been not do that in the next few years.
I agree with you. I think the intention is very clear. You see Kevin Warsh, who will probably be confirmed as the Fed chair in May, has said that he thinks rates should come down. And I think we might see the federal funds rate come down, and that would probably help multifamily and a lot of other parts of the economy. My worry is about residential specifically, because I think that if rates come down too quickly, it will spark fear of inflation, right? Yeah. And then the 10-year stays high, and then it's just, it's a tricky situation unless the big curveball, right, is do they do quantitative easing again, which is the one way to surely drive down. But Warsh has said he's not against that. He wants to shrink the Fed's balance sheet. So I don't know. It's a confusing mess, but I hope my thesis has been they'll come down gradually over the next 2 years, but I don't think we're seeing 4% mortgages in residential anytime soon. My hope is maybe we get to 5.5. Like that would be, I think, meaningful unlock.
Close.
Yeah,
we got pretty close. We were at 5.8, 5.9 just like a little bit ago.
I know.
Yeah,
we just got to get back there.
Right.
Yeah, I think if we can get low fives, they've actually done a lot of research. Zillow was a great data company. John Burns, research and consulting. They've done some research on that. The magic number on mortgage rates to unlock the residential markets between 5 and 5.5. And I do think that's realistic in the next few years.
I agree. Yeah, if we can do that, because there's so much money trapped, so much equity trapped, that once that gets unleashed, it's going to flow through the economy in a very good way.
For sure. I think that's great. As long as inflation doesn't reaccelerate, which is
And now a word from my paid sponsor, PadSplit. Look, if you've been trying to make single-family rentals pencil out in this market, you already know that the math can be tight. With high rates, properties that would have cash flowed 5 years ago now often break even at best. So what do? You wait on the sidelines and miss out, or maybe you find a better model? That's why I want to talk about today's sponsor, PadSplit. Here's an example of the math in some markets. A 4-bedroom renting for $2,700 as a traditional rental may be able to gross over $6,000 a month in a co-living setup through PadSplit, depending on location, occupancy, and costs. The same house can potentially more than double the gross revenue in the right market. And before you think, that sounds like a headache, PadSplit helps with member screening and rent collection while still allowing you to operate the property and make management decisions. This is one strategy investors use to try to make deals work when traditional rentals don't pencil. If you want to see the numbers for yourself, go to padsplit.com/hosts. I'll have a link in the description. Just run the math on the property you already own and see if it's a fit. You might be surprised.
But the sentiment, though, is how, because, Ken and I argue about this a lot, because he's like, what's a quarter point? What's a half a point? I mean, really, is that like a couple $100s on a mortgage? But at the end of the day, it's the sentiment, because I know when they started to drop rates, just that 0.25%, we started to pick up in the Phoenix market. I had tons of people that were sitting on the fence wanting to buy, because I think when people think rates are going down, so I can buy and potentially refinance out of this, it's just a different sentiment than rates going up.
I feel like one of the worst things to happen to real estate in the last 5-10 years is how volatile mortgage rates has been, because I was an investor for 8 years and I never even looked at mortgage rates. It was just a thing, or insurance prices. And now people are looking at it like it's a stock ticker. And they're like, oh, it's up today, it's down today. And for a while, the swings were significant. But like, I'm hoping that we get back to a tighter band where it's 5.5 to 6.5.
But
and
even
then
my
maybe you don't have to
lender-
look at every day.
Well, and even my lender, I locked you in. I got you. Like I just did a DSCR at 6.25 because I hit it right before it started to go up. And he's like, I locked you in. Da, da, da. And it's so funny because it's almost like you're at a casino or something. And you're like, okay, good. You locked me in. I'm good. It's like, or do you lock in yet? Because maybe they're going to go down more. And, you know, it's funny because to your point, I never had that a few years ago when I was buying. It was just like, okay, let me know what the rate's going to be.
Yeah,
It's going to
like,
be around
5.25, 4.75. Like it didn't really make a difference, but people have gotten, you know, it's my fault. I'm always blabbing about it on social media, but I hope we get back to a point where people are thinking about it less because it shouldn't be this like really important part of your underwriting, in my opinion.
Agree with you.
You know,
It shouldn't be the reason.
Right, exactly.
Yeah,
Like it should
you're
be
right.
underwritten on
That's right.
different principles.
Yeah, but at the same time, you know, cash flow can be so tight right now that, you know, 0.5% difference in rates could be a cash flowing deal versus not if you're really tight.
Yeah, that is true. I think, but I think the big picture thing is it is more psychological than it is financial at this point. And I think people are just tired of seeing like, oh, I'm about to buy a deal and it goes up a quarter point. And you could argue they should probably still buy that deal if they were going to at a different rate. But I think people are just tired of that.
But it's also why sellers are tired too, you know, because, you know, we've had it on deals where they have to extend the closing and then the buyer's going to lose their rate and then it's gone up. So, you know, the deal falls apart or they expect some kind of concession or, you know, so there's all these different weird things that are happening, which is why so many deals are falling through right now.
Yeah, I agree with you. It's some of the thing I talk about on the BiggerPockets podcast all the time is like when you make an offer, there's a lot of negotiating ability right now. And the best way to negotiate is to assure the seller that you're going to follow through on it. Like people, you know, if you're going to nickel and dime them, they might not pick you. But if you're going to make a low offer and you know that, you know, you say, I'm going to do a pass fail inspection or, you know, I'm going to close in 21 days or I'm going to close with cash. Like that's the way to negotiate right now. Cause you're right. Sellers are tired of deals falling through, of all these canceled contracts. We're at, I don't know if it's a record high, but like super high relative contract cancellations. And that wears on sellers as well.
Yeah, that's part of my strategy too. It's like make a low offer as is, you know, and if there's a big issue, you can talk about it. But, you know, we're getting $8,000, $10,000, $12,000 inspection bills, which is you know, on a $500,000 house, which is making the whole deal fall apart.
Right. Yeah, it makes a big difference.
So do you think that with rates staying at, you know, 6 or 7% for a longer period of time, how do you feel like that's changing the investment strategy of the average investor?
I think it's made deals not worse, but a little bit less obvious. I think what I talk about a lot in BiggerPockets show is like we have a problem, not necessarily with the market right now. We have a problem with expectations. And we went through this period from 2012 to 2023 where it was just so easy. It was like, it was shooting fish in the barrel. If you could draw up the perfect investing climate, we had it. And I benefited from it. I'm sure you did too. And the pullback from that to what I would say is it's not normal. We have very low affordability, but returns are like sort of in the more normal range right now. Feels really dramatic just because we were sort of at this crazy high. And so what I recommend to most people is just thinking about your time horizon. That's the most important thing in real estate. If you're investing in residential real estate right now for 2-3 years, I wouldn't do it. Personally, you should probably do something else with your money. But if you're trying to buy assets that you're going to be, you know, that you're going to hold for 10 or 20 years, I actually think it's a better time to buy than it has been since at least, I don't know, maybe 2021 or something like that, because inventory is going up and the game now is patience and precision, where I think for a long time you could get away with, you know, shoot first, aim later. And I think now, you know, if you really hone in on good assets and negotiate well, buy below current market comps, there are good things to buy right now. I'm actually seeing better deal flow than I have in a couple of years. It's just not as obvious. And so I think it's really this era that we're in is going to benefit people who do their diligence, who do their homework, and who are going to have the discipline to wait out those good deals because they are going to be there.
And I think that this is a time we're just reverting back to what it's supposed to look like.
Right.
You know what I mean? Like, what we just went through was rational exuberance. Really, it was to you what you said, and I will tell you, like one of the things that frustrates me is when people jump on with this short-term investment philosophy. Now, I by the way, I'm guilty. I've done it, but it seemed to me like the entire market was short-term. The entire market was a big flip, and when things were going up like that, the fundamentals of real estate investing just kind of went out the window. And so what's happening in a good way is that a lot of those people are gone, or are taking a pause or whatever it is, and the market's just settling down with people that I think this is a blocking and tackling long-term business, and it should never be short-term. And it was short-term for a while, and people made money short-term, and so they started believing that that's the way it's supposed to be. But real estate is not a stock; it's a business. And so a lot of people we're treating it like a stock, and in a lot of ways it was doing well for them. But so I'm actually kind of excited where we're getting I would call it the people that believe in real estate long term. They like the tax advantages, they like the cash flow, they're investing for the long term. They're not looking at it for a short-term win, so I just think things are settling down finally, which is good for the people who have been here the whole time.
Yeah, it's just going back to more fundamentals like it's always been. We got so crazy in like 2021 that I literally had a buyer, first-time home buyers about a year ago, and I sent them this home, and they were like, "It's been on the market 22 days. Do you think there's something wrong with it?"
Yeah, you should just throw it out.
Right,
Yeah.
right. And it's so crazy because now at least we're seeing homes sit, but everyone's starting to freak out like, oh, this is a crash because homes are sitting. It's like, no, this is normal. Like, it's normal for homes to sit for a few months. It's not normal for a home to list, and if you don't go see it that day, it's gone.
100%.
Like, that's not normal.
Yeah, it's the expectations are really just out of whack, and people got anchored to this exuberance that you're talking about, this frenzy. And, if you look back historically, we didn't have perfect investing conditions in the 70s or 80s or 90s, and it was still a good business. Like, real estate has been a good business. I think your point about stocks is true, Ken. Like, real estate investing for most people, like the people who listen to BiggerPockets or, people who just want to get into this, investing is kind of the wrong word for it. It's really entrepreneurship. You're a real estate entrepreneur. It is not something you buy and just passively look at, go up and down, and you try and time the market. You build a business around the assets that you're acquiring. No one who becomes an entrepreneur is like, oh, I'm going to build a business and sell it in 2 years. That's just the wrong mindset. It's like, if you're doing this, I've done the math. I've talked about this, but for the average American, if they want to replace their income in real estate, just buying on-market average deals, they can do it in 8 to 12 years, which is awesome. I mean, that is unbelievable. That's a quarter of the time it takes most people to retire in the United States. But somehow we've gotten to this world where that's not fast enough, which is crazy, right? Like, I think, to me, that's like an unbelievable value proposition. You want to get into real estate, you can replace your income in 8 to 12 years. Like, sign me up.
Yeah, that's interesting. I think we went through this cycle where everything was going up so much, crypto, stocks, real estate, that it was almost like a get rich. Like, if you can't double your money in 2 years, it's not worth investing. Yeah. Exactly.
But yeah, I think there was a lot of reasons for that. We were in a very unusual economic period with a lot of money flowing around, and that's probably not coming back, at least to that degree. Even if it doesn't, there's still ways to make money.
So what's your buy box that you look for right now?
I'm mostly a residential real estate investor. So I am looking at small multifamilies, 2 to 4 units. I'm actually trying to join Ken in the multifamily world. I'm starting to look a little bit, but I invest in that mostly passively. But my thesis for the last 3 or 4 years has been about affordability. I really believe that the places where the average American can buy the home that they want, where the average tenant can afford a quality unit, those are the places that I want to be and can still grow. And so I've been investing a lot in the Midwest, primarily. So states like, Michigan. I'm looking in Wisconsin right now. We've gone on road shows to Indiana and Ohio. And I really like them for my approach to real estate because I'm in it for the long term and I like stability. And those places, not only are they affordable, they don't suffer from the supply challenge that a lot of other places do. Now, I know I'm not going to get these huge pops. It's not as exciting. But for me, I've been doing this 16 years. I'm in what I would call like the harvest stage of my investing career, where with my single family or my actively managed portfolio, I buy these kind of like boring things that get me solid cash flow. They beat the market by a couple percentage points, and I'm happy with them. And then I take more risks on the sort of syndication side, where I do more LP investing. I've just done my first flip ever. I said I was never going to flip, but a friend of mine has worn me down and got me to do it. So I'm not sure I'll do another one, but we met somebody. But so that's sort of how I split my investing, and I actually do some lending as well. I really like I think the cash flow and being in a private lender is great.
So right now, we're in a very stalled market. And who do you think is going to break first? Do you think buyers are going to break down and buy, or sellers are going to have to just lower their prices and sell?
I think sellers are going to break down first. We talked about it a little bit. My main economic concern right now is unemployment. Ken alluded to it earlier, but I think the realities I don't even know if it's realities. The inclination to not hire and to pursue AI, whether it turns out to be right or wrong, I think is very strong right now. Businesses have a motivation to do it because, inflation is hurting their bottom line. They're reading every headline on earth being like, oh, I should try this too. And, the idea of that we're going to see like a white collar recession, I think is something that worries me. And whether I think that's going to put some stress into the market, not 2008 stress. I think it's also going to be concentrated where I live in Seattle. We're probably going to see that. San Francisco, I think we're going to see it. Tech hubs, we're going to see it. But I think they are probably going to break first because I do think we'll see unemployment go up in the next couple of years, and they'll have more urgency than buyers will.
I think this is going to be the decade of the blue collar worker.
Mm-hmm.
I really do. I think, if you have real skills, you can drywall.
Real skills.
I'm saying like real skills.
Oh, I call it too. I sit in front of a computer all day. That's not a real skill.
I mean, like
ChatGPT can replace me.
Fix an HVAC system, a plumbing, build something like, whatever it is. By the way, there's a couple reasons for that. One is you can't AI that.
Mm-hmm.
That's for sure. But two, the school system, right or wrong, kind of went after high schools and created these college education, and monetized that extremely well. It pulled all these trades out of the market. Yeah. From when I was a kid, it was very different. There was a small percentage of my high school that actually went to college. The rest went into the trades. That's flipped and changed, and so we have this weird time where there's call it the journeyman, whatever they are, they're aging out. Guys like my dad, who's they're retiring and they're moving on and they're not in the workforce anymore, and there's this gap. And so what's happening is you have that. So why did I go down that rabbit hole? Because I think that's a massive opportunity.
I agree.
For if you focus on that market alone, not a tech market like San Francisco or Portland or Seattle or something, and you start to look at the Midwest, which is where Danille's from, Ohio. Mm-hmm. I've invested in the Midwest. I'm a huge proponent of that. Middle America, hardworking. It doesn't have a bubble to it. It's long term.
It's more like this. It's just slow and steady.
It's you got to be careful of the cyclical cities, and a cyclical city is Silicon Valley, mm-hmm. or any of these tech businesses. And the other thing is I think if you look at, I looked at like the price of a home in 1996, and I know I'm going back, was $150. Now, why is that important? It's important because inflation for the last 30 years averaged 2.5%. So in 30 years, prices doubled. So if something was $1 in 1996, it's $2.07 today. That's a fact. That's what inflation did. And by the way, my mom's a hairdresser. My dad was in construction. They're not real estate investors. They just own their home.
Mm-hmm.
Their home went up.
Mm-hmm.
Like, not because they're listening to us, they're just living their lives.
Yeah.
Right. And so why is that? It's because you get in the inflation run from the debt side of the equation as much as you from the equity. Everybody thinks about the down payment, but the debt, actually borrowing the money at, a few percent and then letting inflation do its thing, when you're getting the money from someone else is the path. And so, and if you can do that in these, call it these small town, these Midwest, these areas that are always going to be fine. There's not going to be high unemployment in the trades.
Right.
And that's kind of my point.
Yeah,
right?
I agree with you.
Yeah.
I invest in a market in Michigan, Grand Rapids, small market, but it just was rated like one of the least recession prone industries in the country. It's a combination of manufacturer, healthcare working, and it's not going anywhere. Education, like those things are going to do well. I think, some of these boom towns are in for a little bit of a shock in the next couple of years, and might level the playing field a little bit. But that's why I really think affordability and, just diversified economies are really important for in residential right now.
How are you setting up your portfolio to be affordable?
Yeah, I mostly right now, I'm looking for units under, if I can buy a unit for ideally 125 or less, I think is what I'm looking for. 150 sometimes. You probably get them cheaper, Ken, at the scale you buy them. But, when you're buying 4 units or something like that, that's usually what you can get it by. And I think that's sort of like the mark of where I can still get, it's hard to get these days. We could still get the sort of 1% rule kind of cash flow. Those places work and they're constantly rented. Like, you don't have vacancy issues if you're buying those kinds of units. And I personally try and upgrade them immediately, make them really good, high quality places to live where people want to stay for a long time. I think most investors learn over time, vacancy kills deals more than most things. And so that's sort of like the affordability thesis that I've been working with. And I think it's going to keep working personally. That's kind of what my outlook for this next sort of era that we're in real estate is.
Now, how do you feel about the single-family homes that are made into multifamily homes, kind of like room-by-room rentals?
Oh, boy. Okay. Well, if you had asked me a couple of weeks ago, I would have felt better about it. But I have never done the room-by-room rental personally. But I started in Denver. We have a lot of those old, like, beautiful Victorian homes, but they would cut them up and I sort of cut my teeth on those kind of places. But I'm replumbing one of them right now. It is such a pain in the butt. I think it can make sense in the right market, but you have to be really good at operating it. Like, I'm just in a place with my own investing where I don't want the operational burden of doing that. But if you're just getting into real estate, I know a lot of people who are making a lot of money doing this rent by the room strategy. And I think in areas where affordability is low, or there's a high student population, or there's a lot of density, those can be really attractive ways to increase your return. My recommendation for people is just really still not ignoring the fundamentals, still buying in a really good location and buying a good asset that's going to hopefully have low CapEx and low maintenance costs. Because I've seen some people who are just like, I'm going to buy this 10-bedroom house, but it's not in a good location. And I think if you're going to do this strategy that takes a particular type of tenant, you can't be in a bad location. Like, they're probably living in this kind of housing arrangement because they want to be close to work, or they don't have a car and they want to walk somewhere. And so I think that you have to be disciplined about buying it. But I don't know how you guys feel about it, but I think it's an interesting option.
I think I would just say I agree with all that. Affordability is going to be the big issue for sure, right? So you can see there. But I also add one more piece for us. If we're going to buy whatever we're going to buy as a rental, I want the single family market to be high.
Mm-hmm.
So I'm always looking for that big contrast. I want, so in other words, if I'm going to buy the $100,000 unit, I want the single families to be 7 or 8 or 900,000 or even $1 million. And why is that? Because the jump from the rent to the mortgage is so big. You want the gap to be as big as possible. And so what I'm looking for is a high barrier of ownership, right? That's a tough one. Now, obviously things can change, but if you're in a high price housing market with an affordable rental, that's gold. But
because you always have demand, right, for your rentals.
I made this mistake personally in Oklahoma City, which I told you the reason we sold was actually, I think the number at the time was about $100,000 is what we paid for the units, but the houses next door were 200,000, 220,000. And so, so what we had was we had tenants for a while and they were moving next door, right? Or the neighborhood, let's say. So, had that neighborhood right next door been 5, 6, 7, 800,000, like we have in Plano, Texas, or somewhere like that, you're going to have longer occupancy, a better tenant for longer, and you're not going to have the turnover and the operating costs and the repair and maintenance and the marketing and all the things that it costs to try to fill that thing. So that's the other piece I would just add.
Yeah, that makes a lot of sense. Just like you're going to have sustained rental demand. The switching costs for people is really high.
Yeah.
It is really high, but tenants now, they're wanting this upgraded experience. And Ken and I were kind of chatting about that on our live last week where, before you could kind of keep your unit dated and it was okay and you would just have renters, but now renters have options. They're kind of like buyers right now. They're the ones that have the options and they're, they don't want to live in a super dated unit and they want technology and there's things that they want to make them stay.
Totally. Yeah. I think this is one thing that a lot of newer investors miss is like, how are you going to set yourself up to compete? Yeah. Because I sold a bunch of rentals in Denver because I saw these beautiful multifamilies going in around me. I was like, I don't have a gym. I don't have covered parking. How am I going to do it? And so I repositioned then into single families because a lot of the supply of single families has gone down. Everyone in Denver has a dog, right? So you go as single family with a yard. That's how I would compete against other units. And so I think that's a core analysis that people need to do right now is like, you're not going to compete probably amenities with new builds. And you certainly don't want to have to try and compete on price. So you need to figure out, are you going to compete on location or asset class? Those are, I think, really important things in this era of investing that we're in because there is a lot of multifamily and they're going to cut their prices faster than you will, usually in most places with rent. And so you're going to be sort of subject to what they do. You need to be prepared for that.
So something that I'm seeing right now is, small landlords got really spoiled over the last few years and they're very rigid on silly things a lot of the time.
Like what?
And because I don't really do a lot of rentals. I predominantly work with people to buy. But if someone's my client and, I'll work with them, but there's all these restrictions on, I don't want someone with any pets. I don't want someone, that they need to, do this or that, or they have to stay a year and that, they just have all of these requirements. And the hard part about it is that now when it comes to, qualifying, I don't think you should change your standards there. But all these little things where landlords got so spoiled, like I was helping a lady find a tenant last month and she wanted someone that can move in a week. She didn't want, we found someone that can move in a month and she's like, nope, pass on that one.
Find the line of people for you.
So it's those kind of things. Or I had another lady that she didn't want any pets. But there was a girl and she had a fish and she's like, nope, I don't want a fish tank in here. And and I had to laugh because she asked me, she goes, why wouldn't she tell me she had a pet until she got here? And I'm like, well, I'm not sure if a fish usually counts. But, so it's like, I'm just seeing it a lot with landlords where they want to be so particular. And the number one thing I'm seeing it on is the pet thing. And for me, I have 5 rentals. 4 of the 5 have a dog.
Yeah.
And I think when you exclude pets, like I just really think that you're setting yourself up to either have to lower the rent or have a higher vacancy. And so some of these landlords, they're just not as experienced. And I just think that they're making deals out of small things. And I didn't know if you've seen that or hear that.
I do think you're right that like people need to screen their tenants well, but I think actually flexibility is one of the ways that small landlords can compete against bigger landlords because, you know, if you're operating a 200, 300 unit, you have a machine going, right? You have your criteria that you're going to underwrite or, screen against, which is great. But like as a small investor, I can individually talk to 5 different tenants and figure out if they're going to be a right fit for my property. And that's somewhere I can distinguish myself and compete against some of these larger operators. So I get it. Some people really don't like pets. I've always allowed pets. I try and come up with creative solutions, but I think it also really depends on the culture of the city that you live in. Like in Denver, like you have to allow pets. Everyone's got a dog, or if you are in the Midwest, like everyone wants covered parking. Like you need to find those little sort of X factors that you can offer or in your asset class that other people can't. And trying to be flexible, I think, is a great recommendation for the average small investor.
Yeah, it's funny. I had a potential tenant and he couldn't rent in the big apartments because they don't allow 3 dogs. Well, he had 3 chihuahuas. So for me, I'm like, sure, you can. Yes, you're good to go.
That's like 1 dog.
Chihuahuas.
Yeah, combine, it's like 9 pounds.
I tell you what solves that completely, that issue, vacancy.
Right,
That's
exactly.
We just came out of the spoiled period, right?
Mm-hmm.
Like I want to go have a beer with that girl just to see where her head is. Like it makes no sense.
Mm-hmm.
Like quality people, quality renters are not easy to find. They should all be screened the exact same.
Mm-hmm.
And you need to lose the rules.
Yeah, exactly. You just got to view it as they're your customers. How are you going to go find customers? How do you go recruit customers? Like you treat it like any other business. I think people expect like great it's a little entitled sometimes. Like I think people treat their rental properties like it's their home. They're going to find someone who's perfect and is going to treat it perfectly. Like it's a give and take. You don't want to find someone who's not going to respect your property, but you also need to respect them and what they need out of the property as well. Like I think that you need to meet people in the middle a little bit more.
Yeah.
Yeah, it's just been interesting because they've just been so spoiled where you would have, 5 or 6 people applying for your property in a week. And now it's much different. And you have to, it's a good balance, right? Because then the tenant and the landlord have to work together.
Mm-hmm.
I'm just finding that the smaller landlords, especially more recent landlords, are just in for a little bit of a wake-up call.
For sure. I think Ken's right. A little bit of vacancy might fix that problem.
That'll be the next seller.
Yeah.
Exactly. Yeah. You go buy their property.
Yeah, exactly. Right.
So you're predominantly investing right now in the Midwest.
Yeah. But I invest in syndications like all over the country as well. Yeah.
Okay. And so when you're approaching sellers right now, what's your strategy?
So I don't do actually any direct to seller marketing. I do most of my deal finding from agents who do their own deal finding. So it's partially like half probably MLS, and then the rest come from working with agents or wholesalers who are going out and doing direct to seller marketing. But what I'm personally looking at is trying to buy portfolios right now. I actually think this is one of the better opportunities right now, and trying to work with landlords who want to get out of the game and who are willing to offer a little bit of discount for convenience. They don't want to unwind 19 single family homes one by one. They want to sell them to a single investor. And so I also find that working with those types of folks, it's easy to get along with them. Like they're landlords, you're a landlord. You can sort of they understand the numbers. And when you go to them and say, this is the number I can pay, this is what makes sense right now. Some of them are delusional, but some of them will make sense. So I think that makes sense. But even when I work or approach a regular seller, I treat it like a business and I use numbers. I just go to people and say, this is the return I need to make. This is what makes sense to me as a buyer. And if you can't do it, fine. I'm willing to say no to that. But sometimes people are willing to understand that this is a numbers game for me as an investor. And it's just really a numbers game of just talking to enough people with that approach until it makes sense to someone.
Yeah, I think a lot of people, they step in and they think if I get 2 no's, then this is pointless and I'm kind of done looking. And about how many approaches do you think it takes for you to get a yes?
Oh man, I think it could take, if you're offering like on market, oh man, probably 20. I would think it could take, but I think it's worth it.
Mhm.
I guess I'm lucky because I started, in 2010. You would never buy full market value by then. So I got used to making under value, under list offers. I think people who got started in 2020 and 2021 are confused by this, but like you normally try and negotiate your deals down. And I think, I said earlier, I think this is like the era of precision, and you need to be able to walk away. A lot of people during COVID, it was the frenzy around it was so high. People were like, oh, I'm going to lose this deal. And they would throw money or they'd waive contingencies. And I just don't think you can do that. If it takes you 10 no's, if it takes you 20 no's, if it takes you 30 no's, I think you just have to get used to that. And I think you have to find agents who are willing to do that too. Because I do see people say, oh, my agent doesn't want to offer on that. It's like, well, it's not really up to your agent what you're willing to offer or how many offers you want to make. And I think if you're working with a good investor-friendly agent, they will be willing to do that for you. And that's just what it takes right now. Like if you're not willing to do that, you're probably not going to find a good deal.
Yeah, what I like to say is really very similar to you. I just say, listen, it's just math.
Yeah.
Like the math sits over here. It's not between you and I. The math is the math. Mm-hmm. And you can argue with the math, but you can't argue with me. So argue with the math. If the math works, we move forward.
Right.
If it doesn't work, we don't. And this isn't a personality issue. It's literally just argue with the math.
Yeah, I think a lot of times, especially if you're working with a homeowner and a single family, right? It's emotional.
Yeah.
And you have to work through that. That can be harder. You'll probably have a higher failure rate. I think when you're working with an investor who also understands the math.
Or a home builder or somebody that's, a value add or a flipper or whatever, they get it.
Yeah, they do. Right.
Right.
If you can't meet on a number, so be it. Like that's just how the game works. But you have to be that disciplined about it.
Yeah, there's a lot of agents too that'll not want to offend the other agent or not want to offend the seller. And this is the time where there's no offensive offer really, because houses are sitting and people want to sell them. So it's just a matter of what will they sell them for.
It's so weird. Like, so I guess I've done 2 flips now. One of them I partnered on in Seattle. It sat on the market for like 6 months. And no one even made me an offensive offer. I was like, someone offend me. Like, where are the offensive offers? And I think it's because what you're talking about. Agents aren't used to it. And I was like surprised because I would have taken it. And like you said, flippers have a sense of urgency. You offer a flipper, maybe it's not the ROI I wanted, but it was still coming out ahead. I would have taken it, so it's just a culture change, I think, for a lot of buyers, sellers, and agents.
Yeah, especially, the agents that are newer into the game. And, it was funny. I went to this real estate thing and the lady goes, oh, that guy makes a bunch of offensive offers. And I was like,
oh,
okay.
Let me meet that guy.
What does that mean?
That's who you want working for me. I want that guy.
Right, exactly. And it's interesting because, to your point, like sometimes I had this listing, the guy was older, retired, didn't need the money, and somebody made us a super low offer the first day this condo was listed that I assumed he was going to say no to. And he just goes, yeah, that's fine. I don't care. You just never know. He didn't need the money. So he's like, what? I don't want to leave it on that market to get $30,000 more. I don't care. And so it's those kind of things that people just don't realize. There are people out there for different reasons that will take a low offer.
And it's going to happen more and more. I think that is the benefit. Every real estate's got its pros and cons. Every market has its pros and cons. I think right now is we're not going to see appreciation in the way that we have for a little while. The pro is you're going to buy cheaper. So you could still get equity returns. Like you just need to, this is the game plan now is what we're talking about is completely. Like you have to buy low because you have to generate your own equity gains. The market may not do it for you. I hope it does, but you can't count on it. And so this is the stuff that guarantees you an equity gain.
I'll bring up something really interesting. By the time I got smart enough to really, really go aggressive and buy a lot of stuff, it was after the 2008 crash. And I had done a lot of deals up to that point, but again, we were in a run up to that point. People forget about the run.
Yeah.
The run to 2008 was a run, just like we went through. The interesting thing is there's no value add
Exactly.
in 08, 9, 10, 11. It's not. It doesn't exist. So you buy for fundamentals, and then guess what happened? Value add came on the properties I already owned. So I knew you buy today based on cash flow, and then maybe, if you're lucky, there's a value add strategy later, but the cash flow's in between. And that's the right way to do it. You don't have to have a value add strategy when you buy. It can be, if it's a long-term hold for real, you can have a value add later. We have plenty of assets that we bought in 2008, 9, 10, 11, 12 that we didn't actually even renovate till 15, 16, 17, 18 because you wouldn't.
Yeah, right.
It
didn't make sense.
No, it didn't.
But you bought it because the price was right and the value was good.
Right. Cash flow.
Yeah.
We managed it well. The tenants were paying down the mortgage. We got tax benefits. The rental market was good. All that. And then all of a sudden, rents started going like this. And we're like, and rates started going down. We're like, hey, let's refinance and value add this. And then we'll get another bite at the apple. And so it's a long-term thinking. And so today, people need to be thinking, the strategy isn't to value add tomorrow or the next year or the next year, to your point. This is a price per pound, cash flow, tax play. And then if you're patient, it will be there at some point.
I completely agree. If you look at rent growth over time, this is nerdy, not nominal, but real home prices over time, inflation adjusted home prices over time, they go up, but it's actually more like a stair step sort of function rather than this linear function. And so the game as an investor is be in the market for that stair step. Because no one really knows when it's going to happen. I spend all day looking at this. I don't know when it's going to happen. Yeah. But I know that it will happen again. And so, my whole philosophy is buy great assets because when that jump happens, then you're in the position to really hit a home run. And it's okay to hit a double or a single or a double until then. Still, my opinion, it's still better than being in the stock market with a lot of my money. And so I'd rather just take those predictable returns in terms of tax benefit and cash flow and amortization. And then if you're in the market when those pops hit, you look like a genius. And that's the fun part.
That's right. That's exactly right.
Well, thanks, Dave. We appreciate you being on. Where can everyone find you?
Thanks for having me. You can find me on the BiggerPockets network. I host the On the Market podcast. It's a data and economics show, or the BiggerPockets real estate show, or you can find me on Instagram at The Data Deli.